When I was a commercial banker in the late 1980s and for most of the 1990s, there are a couple of rules of thumb that were pretty well universally applied to limit the size of a home loan. These were: 1. The initial loan should be less than 3 times household income before tax. And 2. Repayments on the initial loan shouldn't exceed 30% of household income before tax. But with today's housing prices, such limits would now prevent most people from being able to borrow anywhere near enough to be able to purchase a home. So, views on what are regarded as excessive home loans have clearly changed considerably. A September 2021 article at mortgagebusiness.com.au noted that, and I quote, "According to the Australian Prudential Regulation Authority, APRA, high debt-to-income ratios are those over 6 times income. This accounted for around 21% of new lending in the June quarter, 2021. So, 3 times has gone to a staggering 6 times over the past 25 years or so. It causes one to ponder, is it laxer lending standards that have led to higher home prices? Or have higher home prices forced lenders to relax their standards? Regardless, this video examines how the 4 major banks would currently, that is at April 2022, assess maximum home loan borrowing power for a case study couple, the Greys. Using the finhealth personal finance software, we then examine the consequences of the Greys borrowing the largest indicated loan for achievement of their version of financial independence. Hi, I'm John Lesky, recently retired personal financial advisor and founder of finhealth, a tool to guide you to your financial independence. Now, Gary Gray is aged 38 and his wife Jerry is aged 36. They both wish to retire, that is, cease work totally, at Gary's age 65. The table on the screen provides the relevant information that was requested by all of the 4 major banks' online home loan borrowing power or maximum home loan calculators. It should be noted that not every bank asks for all these inputs to provide an estimate of the Greys' maximum borrowing power. Common information required includes: who are the borrowers? Are there any dependents? Is the property to live in or for rental? What's the applicant's income before tax? Although for ANZ and CBA, it was not clear whether superannuation was included or excluded. For these banks, the income figure used was grossed up for superannuation. They asked about monthly expenses and credit card limits. The table shown now provides the maximum potential loan calculated by each bank's calculator, to which is added a $500,000 deposit to obtain the Greys' maximum housing spend. The column on the far right calculates an implied maximum loan to gross income of $341,000. For all banks, it's short of the APRA regarded excessive 6 times, but well above the historical 3 times. Next, we assume the Greys are able to qualify for the largest CBA loan and outlay the maximum $2.514 million on their first home. The purchased home will require at least $300,000 of renovation that currently can't be afforded to bring it up to a condition that the Greys desired. So, even though a bank is willing to lend the Greys almost 6 times their current gross household income, is this consistent with the couple being able to eventually repay the loan and accumulate sufficient investment wealth to be able to retire by Gary's age 65? We examine this issue with the finhealth personal finance software. Initial inputs for the software mirror the information provided to complete the bank's calculators and are shown on the screen. An additional assumption is that total current superannuation is $450,000. We also assume a target growth asset allocation to be achieved by retirement of 60%. That incomes and expenses estimates increase in line with inflation to Gary's age 65, and desired retirement spending is the same as current spending, adjusted for inflation. The personal financial dashboard generated by the software for these inputs is now shown. Superficially, it suggests that the Greys will be able to both repay their home loan and accumulate sufficient net investment wealth to be in good shape for retirement by Gary's age 65. But there are a number of real-life expectations that the bank's online calculators don't directly explore. For example, 1. The Greys' expenses estimates fail to adequately allow for the costs of capital maintenance, particularly for home and car replacement. This could easily be $10,000 to $20,000 a year. We'll assume $10,000 a year, which is most likely on the low side. 2. The Greys wish to have 2 children that wasn't acknowledged in the loan application to maximise their borrowing power. They would like to have the first, hopefully, within the next 2 to 3 years. It's possibly conservative to assume that at least an extra $15,000 a year should be allowed for children-related additional expenses, say to Gary's age 60. 3. In order to save on childcare costs, Jerry would work part-time for 10 years after the first child arrives. Let's assume for those 10 years she earns 40% of her current full-time salary. 4. The Greys want to be able to do the $300,000 renovation to make their home more livable in 5 years' time. And 5. Both incomes and expenses tend to rise over time, reflecting higher living standards. We assume incomes and expenses, including desired retirement spending, rise at 1% a year above inflation. The personal financial dashboard reflecting these changes is now shown. Needless to say, the revised dashboard shows a much less optimistic picture in terms of achievement of financial independence by Gary's age 65. In particular, the projected retirement expenditure multiple declines from a very comfortable 39 years to a significantly below benchmark 12 years at the desired retirement age. While for both scenarios, the bank is comfortably projected to be repaid, the loan size and cost of house purchase mean that the Greys' other aspirations may require some modification. Unfortunately, without the reasonably detailed look into the future provided by the finhealth personal finance software, this may not become apparent until much later in life, necessitating significant undesirable lifestyle adjustments. The message is that although you may qualify for a loan that's 5 to 6 times your household income, don't blindly assume that all your other life expectations are financially achievable. At least our case study couple in their 30s have lots of time to adapt. But it's interesting that none of the online home loan borrowing power calculators ask about the ages of loan applicants. A couple aged in their mid-40s that 1. Provided the same calculator inputs as the Greys, 2. Took on the same size loan and home purchase, and 3. Had the same income and spending expectations, would almost certainly need to significantly change their lifestyle expectations to be able to retire at age 65. This isn't a situation that we would equate with good financial health. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.